So now let's solve question 4 April 2023. So the paper question asks us to explain 6 methods of creative accounting. So basically, what's creative accounting? Creative accounting here is just all about manipulating the financial statement. The financial statement can be manipulated in such a way that it will still be in accordance with the accounting standards. Yeah, that's why it's creative, but it's wrong. It's not the right thing that's supposed to be done. Let's have it. So the creative accounting involves manipulating financial statements. Who manipulates this financial statement? The management. And the manipulated financial statement will still comply with accounting standards. So the methods here we have number 1, window dressing, of assets valuation, and the of statement of financial position finance. So about changes in accounting policies. This is of estimate. So also about capitalization of expenses here. Then another one, so of earnings management. So window dressing here, this involves where an entity recognizes the transaction that's meant for the previous period in the current period. So then an entity can do this majorly maybe payment to supplier. So the entity might not want the payment to affect the cash flow for this period. So the entity might just decide, okay, how about we recognize it in the next period so that it won't affect our cash flow for this period. So, but majorly that act is window dressing. So here now the financial statement previous period would reflect growth, liquidity, profit, or profitability, but it doesn't reflect the reality. The reality is that transaction could have affected the liquidity or profitability here, but because maybe due to the users might complain. That's why they have to recognize it in this current period. So it's not the right thing to do. So another is this asset valuation. The entity might overvalue or undervalue the depreciation associated with the assets in the statement of financial position. So how can this entity do this? By using inconsistent depreciation policy. An entity might decide to change from straight line method to reducing balance method. Maybe because for straight line method, it's the depreciation will just be the same for all the years, but for reducing balance method, in the first year would have an increase in expenses. So the entity might just want to do this to reduce profit and to reduce tax liability, but it doesn't make it right. So let's now look at this off statement of financial position finance. So this off statement here, it involves hiding liabilities or assets off the balance sheet to improve financial ratios. So that an entity might decide to not recognize asset liabilities in the financial position, just to make our ratios looks attractive, but that's not the right thing to do. Majority of transactions should be recorded as at the period in which they relate to. So now let's now look at the changes in accounting policies or estimates. An entity might decide to change its accounting policies or estimates to make the financial statement look attractive. E.g., an entity can switch from cost model to revaluation model in order to improve the gearing or to change the depreciation style of the asset or to change the depreciation of the asset. What we are trying to say is that an entity might decide to switch from, let's say, cost model to revaluation model under IAS 16 in order to improve the gearing. So what we're saying in essence is that when an entity uses revaluation model, it means that the assets will be revalued, and it can give rise to revaluation gain. It can give rise to revaluation gain or loss. Revaluation loss, that's impairment. It can give rise to revaluation gain or impairment, which should also affect the gearing of an entity, and it would also affect the depreciation and also capitalization of expenses. And this involves capitalization expenses in order to inflate assets or to reduce expenses, so as to showcase improved profits. So what we're saying in essence is that an entity might purposely capitalize an expense. An expense here is material, minimum material. So an entity might decide to capitalize minimum material expense. Normally now, material expense here, for example, purchase of assets. So basically that one should be capitalized because it's an asset we bought, right? So, but an entity might now decide to capitalize stationery just to avoid recognizing it in the POL, because if you recognize it in the POL, the expenses will be inflated. Thereby, it will also affect the profit. So, these are dubious means which entities can adopt. So, let's have earnings management. What this earnings management is saying is that an entity might artificially improve the earnings, even the profit too. And when the earnings is manipulated, the profit will be impacted. An entity might artificially improve the earnings by recognizing revenue, even when they are not yet earned, even when the earnings are not yet to be recognized. That's that for the A part of question. Now let's go to the B part of question. So the B said that we should list the types of profitability ratios. First one, we have the return on capital employed. The return on capital employed as it looks at. So here now this measures the return generated by an entity using the working capital invested. So formula is what ROC equals to the profit before interest and tax over capital employed times 100. So another one is that return on equity. So this measures the returns generated by an entity by utilizing the shareholders' funds. The formula for this is ROE, which is a profit after tax over the equity multiplied by 100. So Roman figure 3, we have gross profit margin. So this measures the company's profitability after deducting the direct cost of production from the revenue generated. So the formula for this is gross profit over revenue times 100. So then the last one, which is the net profit margin. So it expresses the company's net profit as a percentage of revenue. So the formula is NP margin, which is what the net profit by revenue times 100. So with that, we are done with the question.